Everybody, welcome to Intermediate Accounting 17th edition video solution walkthrough for CUSA, Wengen, and Warfield. This is problem 14-9. The textbook authors are Don CUSA, Jerry Wengen, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, let's get to it. So right over here, I have entries for a zero interest bearing note. Sabonis Cosmetics purchased machinery on December 31st, 2019, paying $50,000 down and agreeing to pay the balance in 4 equal installments of $40,000 payable at each December 31st. An assumed interest rate of 8% is implicit in the purchase price. Prepare the journal entries that would be recorded for the purchase and for the payments and interest on the following dates. Round interest, round answers to the nearest cent. Okay, so this $40,000 that I'm paying on 12/31/19, 12/31/20. Excuse me, I'm not sure if you got a cut of that sneeze, but it was pretty good. Okay, so we've got $40,000 being paid over each of the next 4 years. But if we're looking at this, we know that these future dollar amounts are not the same. It's not the same dollars. A future dollar is not the same as a dollar today. So what's the value of these future payments? So what we're going to do is we're going to say the present value, we're going to take one of the payments, and because it's the same payment, we're going to take the present value of an ordinary annuity of $1, and we're going to take 4 periods, the number of times the amount is paid at 8%. So when I come over here to the present value of an annuity table, 4 periods at 8% is 3.31213. So the value of these future payments today is $132,485. Okay, so the total amount that I'm going to be going through and recording this machinery for is going to be for my down payment for $50,000, because that amount on 12/31/19 that amount right here, it's going to be 50,000 plus 132,485. So what I'm going to do, though, is I'm debiting equipment for that amount. Now, at the same time, I know I'm paying out cash of $50,000. That's happening right now. I also know that I have a note payable. My note payable amount is going to be $160,000, because that's the amount that I have to go through and pay each and every year. Okay, so the difference between right over here, I've got total debits of 182, total credits of 210. So this difference here is going to be a discount on notes payable. And that amount is going to be 210,000 minus 182,485, or 27,515. Okay, so we've gone through and we've recorded this equipment. So what are we going to have to go through and do for, let's see what it says over here with regards to the depreciation. So I purchased machinery, paying 50 down and paying the balance for recorded for the purchase and for the payments and interest. So we don't have to worry about the other part. Okay. So right over here, right, we know that on 12/31/20, we know that we're going to be paying out cash of $40,000. Okay. And we also know that we're going to be debiting our notes payable also for $40,000. So we're going to be making this entry every single year. But the thing we have to figure out, though, is that, well, what about the interest rate? So my total note payable at 12/31/20, 12/31/21, 12/31/22, and 12/31/23. Well, my note payable before, basically for my first payment here is at 160. So then my discount on the note payable is right over here at 27,515. So my note payable carrying value is going to be right over here at 132,485. And in the words of Ingrid, we're going to bust out the T accounts. That sounds like a great idea. Ingrid's no longer in my classes, but she's an amazing student. And the reason why, she said, Tchaikovsky, do it in the T account, right? So we got to make sure that we're putting the values in the T account. Show it in the T account, right? Do the work in the T account right over here. So I've got notes payable at 160. And my discount on notes payable of 27,515. Now my goal is to get this down to 0, because when I make this last payment, that's what I want it to be. So my interest rate is at 8%. So my interest expense is going to be 10,599. So my discount amortization is going to be the same amount, or 10,599. So I'm going to debit interest expense, and I'm going to credit discount on notes payable. Okay, so my interest expense is 10,599. My note payable, or my discount on notes payable, is 10,599. Okay. Now, what happens next, right? So this was as of 12/31/19. So I make my first payment over here. This is 12/31/20. So, okay, right over here, 40,000. Okay. So, and then my discount on my notes payable, this balance over here was also as of 12/31/19. And my first amortization is 10,599. So when I get to 12/31/21, though, this is where I can sometimes get tripped up, is that my notes payable balance now is at 120,000. So my note payable is going to be decreasing by 40,000 every single year. And why is that? Because on every single one of these years, I'm going to be going through on 12/31/21, 12/31/22, and then on 12/31/23, I'm going to be making the same entries every single time. Likewise, I'm also going to be doing these entries over here for the interest expense and the discount on notes payable, although the amounts might be slightly different. So my discount on notes payable, this has also actually gone through and changed. My new discount is going to be over here at 16,916. So my note payable carrying value is 103,084. My interest expense is going to be 8247. And that's what I'm going to be amortizing my discount for. So right over here, 8247, 8247. So my discount on notes payable, and we'll just kind of write these out over here. So I've got 8247. Okay, so my new discount is going to be my prior discount plus what I just amortized. So my note payable carrying value is now 71,331. So my interest expense is going to be 5706, and that's going to be the same amount for my discount amortization. Okay, now over here, my discount on my notes payable, I amortized it again. I'm now left with 2963, and hopefully that's going to be the amount that I'm going to have over here, 2963, right over here, 2963. So kind of finishing this up in terms of doing journal entries, it's going to be 5706, 5706. And then this over here is going to be 2963 and then 2963. Of course, I would put journal entry descriptions for all this stuff here, for all these entries here, but that's what I would want to go through and do. Okay, so that's how I go through and handle problem 14.9, which is 0 interest-bearing notes. You'll see I'm a big fan of going through and writing out all the work just so I know that I've done this correctly. And by the end of this, right over here, my total amount of my discount on my notes payable is going to be equal to 16,916. So again, I've zeroed this out, and by the end of this, this is all off of our books. So thank you for joining me here today. I look forward to seeing you on the next video. And thank you again to Wiley. Please don't forget to like and subscribe. If you'd like to see other solutions, feel free to ask for them in the comments. Have a great day.